How about you have a mutual fund and it's an absolute train wreck, and you got to find somebody to salvage the big day? He is here, Nick Thakore, with us from Putnam Investments, and it is on Putnam Voyager. Nick, we're thrilled to have you here.
Tom, thanks for having me.
You came in, and what a track record. You went from, Putnam Voyager was more speculative. You rebuilt the fund on blue chip stocks. What have you done right the last 3 years? What was the #1 strategic thing you got right that led to the recent good track record?
I just think the last few years, there's been so much fear, so much uncertainty, so much skepticism that it's created a fantastic stock picking environment. So all we did is we used a very disciplined approach of focusing on growth and valuation and stepping up to the plate on stocks. We've just been able to make a lot of money on stocks. And then finally, we've done well in down and up markets, and the combination of that can yield some powerful results.
And folks, it's so critical here. It's about return and the risk taken. Let's bring up the number. It's a Nick Thakore number, and it's 0.63. And it's the 3-year Sharpe ratio of Putnam Voyager versus a puny 0.19 for the S&P 500. That's a measurement of risk given the, a measurement of reward given the risk taken. Nick Thakore, right now, are you worried about making money, or are you worried about avoiding risk?
Well, I always care about risk, but I think this is still a great opportunity to make money. So I'm very much focused on the opportunities in the market as a whole and individual stocks.
Does that include the financial sector? I know you're like JP Morgan and Wells Fargo. The financial sector, I mean, we got a nice bounce off the collapse. Do we get a further appreciation here in blue chip bank stocks?
Yes, I'm very bullish on financials. I think over the next couple years, financials are likely to have one of the highest growth rates in the market. I think the valuations are extremely attractive. I think these companies are on the cusp of being allowed to pay bigger dividends and buy back stock. I think these stocks are very underowned, and based on the kind of earnings recovery that's possible, using JP Morgan as an example, I think the stock can get into the 60s while it's in the 40s today.
You look at this, folks, and here's the rule. Sell side, like people doing research, I go, what's your single best buy, blah, blah, blah. Nick's on the buy side, so I'm not really supposed to talk to him about individual names. I mean, you can do a little bit of that. Give me another name, Nick. Everybody likes JP Morgan. What's your outlier call on financials?
I would say that the area of financials that people don't like as much would be insurance, and yet it has some of the similar stories that the banks do. And so what I see from insurance companies are not necessarily great long-term stories, but great earnings growth off the bottom at very attractive valuations. So an example of that would be Hartford, where it trades at a huge discount to book value and ought to get back closer to book as their earnings growth materializes.
Well, let's bring up the Apple chart here, folks. Nick Thakore on Apple. What a moonshot. Here's a Jobsian mountain chart. A mountain chart, folks, is where you're in a mutual fund like Putnam Voyager and you do well, and it can be very deceptive arithmetically. It's logarithm month here it's surveillance midday. If you did this responsibly, it wouldn't look this silly. But here's Apple, Nick Thakore, straight up, straight up, straight up. Can you still own Apple here?
Yes, you can still own Apple here. Instinctively, I want to not like the stock because it's up a lot. It's the most popular stock in the market and the second biggest market cap in the world. But the problem is the combination of growth and valuation is just too compelling. In fact, this is a rare stock that's gotten cheaper as it's gone up. Since the beginning of 2010, Apple's stock is up 75%, but earnings projections are up 130%. So the PE has gone from 20 times to 15 times. And on reasonable estimates of 2012 earnings, the stock is only around 12 times earnings, which is a market multiple, not even counting the $65 a share in cash. And the real key to this story is the iPad, in my opinion. It's accelerated growth and extended the period that Apple can grow. 2 years ago, this was 0 in revenues. This year, it could be $20 billion in revenues. And just recently, Apple was talking about the possibility that the tablet market in volume could end up being bigger than the PC market someday.
Nick, there's this mania about Apple. You're a cold-hearted securities guy. What does the public miss in their analysis of Apple? It's the iPad, it's the iPod. Do you know that two of my three children, their cell phones broke within 2 weeks of the announcement of the iPhone? That's incredible that that happened. What does the public get wrong about Apple that we need to know?
Well, I think that people who are skeptical are rightly to be skeptical because it's so big, but it's just the fact that they keep adding markets that are so huge in size that even a company that big can keep growing. So I think the question is, right now we have enough growth with just the iPad. The question will be, once that's discounted in the stock, what's next? And is there anything big enough left to own the stock thereafter?
Right.
Personally, I want to be early selling the stock. I just think it's still too early to do so.
Never enough time. Nick Thakore, thank you so much. Putnam Voyager Funds.